Hello, everybody. Welcome to Friday. Welcome to the Rebel Income live stream. Looking forward, as always, to our session today. Give me just a second while I get sharing set up. There we go. Outstanding. Really excited to see everybody here today. Hopefully, we'll get a lot of participation as we get things rolling. Just a couple of simple things by way of just trying to maximize the exposure here a little bit with YouTube. If you like some of the things that you see here, excuse me, you can go ahead and indicate that using the emojis in the chat area. You can also leave comments as Jay and Gib have there. Likes on the video are always also appreciated, as well as shares. And we want to try to expand the reach of Rebel Income as much as possible. So everything you can do to help move those things along, show engagement, as well as hopefully get some other people coming in and participating in the live stream would be very much appreciated. This live stream is all about income generation using the options market, and some of the things that we can do to leverage what I call as the low-hanging fruit of the market, to not only generate income but set up practical opportunities to own really nice companies at attractive prices. And so, in that vein, what we do here is to kind of talk about some of the currently open trades that I've been publishing in the Rebel Income System blog, and evaluate those in real time. That's part of the reason that we're doing this while the market is kicking off, and also why we're doing it on Friday, since options expire on Friday. There's weekly as well as the standard monthly options. There's always something to evaluate, some dynamics to try to look at in time while the market is moving. That's the way that those things impact not only the positions we're looking at, but also the way that we think about them, and the way that we may or may not need to adjust our approach. So, in that vein, we've got a lot to talk about today, and we'll hopefully have some opportunities to hear from you and look at some of the stocks that maybe you're looking at that haven't crossed my desk, and so that's always fun. So let's go ahead and dive in and get straight to it. Since it is the 14th, there's actually only one one trade that is set for expiry today, and that is a put sale on FCX. So we'll be getting to that. When I say there's a lot to talk about, I mean the fact that there's actually 1, 2, 3, 4, 5, 6 different positions that are set for expiry next week. Most of these are covered calls, and that's fine, but it also what that means is there's going to be lots of opportunities to look at some of these currently open positions with still a week of time left in those trades, and try to evaluate how those stand with some time still going in. That changes the evaluation process a little bit, some of the logistics and some of the mechanics a little bit from what we'd be doing with a trade like FCX that is expiring today. And then, of course, we have a few others that are a little bit later. Well, okay, there's one more that's a little bit later, and that's on the 5th. And that was this week's put sale. So let's go ahead and get straight to it. We will start by taking a look at EMN here. This is Eastman Chemical. This is a put sale, obviously, that I placed in the last week of October. This was about a 1-month trade. I assume by the end of next Friday at least. And I sold the $55 strike price, bringing in a little under 2% for the premium in this trade. So this was a nice setup in and of itself. EMN at 55 is a really nice price for the stock, and it's kind of interesting to look at charts and see what the scale on some of these looks like, where you'll see stocks that make a move of multiple dollars at a time, and it doesn't really look like a whole lot. And then again, you get a stock like Eastman that has actually moved a fair amount. If you think about, where it was from this bottom at the beginning of November to where it peaked up here around 63. Down here is maybe about 58. Here is about 63. There's about a $5 difference. And right now the stock is sitting right around 62. So my strike price that I sold was 55. Now I did, in the case of this one, I did something that I don't normally do, and that's, the 22nd of October is right about here. And so I sold this. I sold this right around this price. Stock was right around here when I sold the put sale. EMN is one of these stocks that doesn't have weekly options. It also only offers options in $5 increments. Let's go ahead and take a look at it. And so, where a lot of times we're working with strike price increments that are within $1 of each other, or maybe $2.50. This one has a much wider difference. There we go. Here's the $55 strike price that I sold. The stock was somewhere between here and 60 when I sold the put option, but 55 was the nearest strike price that was available. So I was able to sell that, bring in an attractive premium. If I wanted to buy this back today, though, I have to pay about 30 cents for it. So that's just the current asking price. Looks like last trade was 10 cents. If I wanted to try to leverage that a little bit, I could. There's been no volume on this yet so far, though, just in the first few minutes of the session. So there's a good chance if I put in a buy to close, if I wanted to close out the obligation before expiration today, or before expiration next week, I could. On the other hand, with the stock several dollars above it, above that strike price, there's probably not a whole lot of reason to do it. Especially since there's not a lot of, here's $1.05. Well, this isn't horrible. Buying it back now, going out to 35 days, this is a little under 2%, going out to December 19th. So that could be an interesting one to roll, potentially, if you don't mind sitting in a new trade for a little over a month and still be working at the same strike price. Well, this is the asking price you'd be selling at the bid. That's 60 cents. That's not so great. I apologize. I'll take it back. On the other hand, what I just realized that I skipped right over is today the put sale that was expiring day, and that is on FCX. So I just went down to the bottom of my list instead of going to the one that is actually on deck right now. So let's take a look at FCX. And again, for context on this, I sold the $39 strike. Sorry. So right here. Brought in 67 cents. This was a 9-day trade, bringing in a bit under 2%, 1.72. But for a little over 1 week, this was a very, very nice setup. Give me just a second. Not sure how I turned that cursor on, but okay. That was interesting. So let's take a look here at the stock. Now we can see that opening up here, it gapped a little bit lower. I'm not sure exactly why. Here we go. Pre-market trading due to declining copper prices driven by weak economic data from China, raising demand concerns. Okay. So that's following the pattern of some of the other stocks that tech stocks and so on that are looks like are set to sell off here towards the end of this week. That's not necessarily a bad thing. It does look like the stock so far is holding up pretty well. Its low for the day is a little bit below 39. So down here is 38.88. That's the low for the day here just a few minutes into the session. So it does look like I could be assigned, but on the other hand, at the moment, it looks like it's recovering pretty nicely. And if I am assigned at 39, I'm okay with that as always. My method is to accept put sell assignments. That's why I work with very conservative position sizes, for one thing. But also, this is a price that for me represents a really nice purchase price for the stock. And so, along with the income component of this, for me, this is an opportunity to put selling offers an opportunity not only to generate really useful income, but also to own stocks I like at really good discount prices. And that sets up opportunities to work with the kinds of covered call trades that I've been able to set for the last few weeks, in which we have a whole bunch of them coming up for expiration next week. That's only possible if you don't avoid put sell assignments. The flip side of that is that sometimes that also means that you're going to be riding some downward trends in stocks that are going to continue to decline. We're selling usually into bearish sentiment and momentum. This is kind of a contrarian method because we're looking for stocks that are offering deep discounts. So there's a little bit of that contrarian mindset that you have to be willing to buy into for these. But at the same time, um, that's one of the reasons that I like to use put selling, is to set that price, that purchase price that for me represents a useful value. In the case of FCX, then, if I am assigned, that's fine. With the stock set to expire today, though, if your preferred method is to not take that assignment, and maybe that's something you're a little bit worried about, let's see what some of the opportunities and possibilities could be. Maybe if you just want to try to manage this a little bit more actively, because there's possibly an opportunity to do something different with it here. Now, keep in mind, I sold the $39 strike price option. I brought in 67 cents. And this was a 9-day trade. So if I wanted to buy this back right now, it does look like I'd be paying 25 cents is the current asking price. Pretty wide difference between the bid and the ask. So if I wanted to try to manage this a little bit, yeah, I've got plenty of open interest and volume here. So I could probably put in a bid price, or excuse me, a sell to close asking price at maybe 15 cents, 10 cents possible. But even if let's just go ahead and assume for a minute that I'm not going to try to dictate what price I want. I'm just going to go ahead and go ahead and work with what the market is asking right now, just because I don't want to wait. And there's still a 42 cent net credit that I'm bringing in on this. Again, this is a 9-day trade, so it's a little over 1% for a little over a week. That's even just applying this rolling method. Even if you're not afraid of taking an assignment like I am, there may be some logic in doing this. I'm going to throw this out to you. I'd like to see your comments here. What would be the positives or possible negatives of buying this back, closing out the obligation, freeing up that cash before the market closes? I know we talk about this a lot, so some of this is going to sound obvious, but there is also a little bit of a specific angle I want to try to emphasize with this today. So I'd really love to see what your thoughts are about it. Gib, my goal is to never take assignment, but I love to roll. So there you go. Maybe this is just the preference, and maybe it's the opportunity to increase trading frequency, right? And again, that's kind of the first answer that most of us take when we're thinking about this is an opportunity to leverage trading frequency, and so you roll, and this doesn't sound like a really huge difference. Excuse me, just a moment. This is a trade that is set for expiry today. So if I buy it back today, what difference does that make? Well, the money becomes available to me before the market closes. The $3,900, I sold one contract here. So that's 100 shares, $3,900 I had to put on reserve in order to secure this trade. If I buy this back now, that money becomes available to trade immediately, as soon as this trade closes. If I do what I normally do, which is to let it expire and the stock stays above $39, my $3,900 in reserve is still going to come back to me, but it's not going to be available for a new trade for usually at least 1 to 2 business days. So for my purposes, literally speaking, that means the soonest that it's going to be available is Tuesday. Again, maybe this doesn't sound like a big difference, but we are talking about overall a difference of about 3 days. Here's what that means. If I add 3 days to the total duration here, that means that the ability to recycle the same $3,900 would be about every 12 days. This is my normal method. If I'm setting a 9-day trade, I'm actually, if the trade expires worthless, I'm going to be able to use the same capital again about 12 days later. I'm going to have to wait that long. This keeps this trading duration at 9 days. So here's the difference. Let's go to the calculator. Okay. I'm going to put this right here. Really quickly, let's think about trading numbers. So this is 365 days, which represents a full year. If you're able to place a trade with the same money every 9 days, and again, as always, this is simplified, right? This is not going to happen every single time. So these numbers are essentially simplified guesstimates. But if you're able to recycle and reuse the same capital every 9 days, over the course of a year, you're going to place 40 trades. Okay. If I'm doing it every 12 days, as I mentioned, if I'm letting the option expire and I'm waiting the normal settlement for that money to come back and be available again, now we're talking about 365 divided by 12. Okay, that's a difference of 10 trades. All right, keep that in mind. 30 versus 40. Now let's think about what actually happens here if I do take this rolling approach. How much of a difference does it really mean when I have to give back some of the premium that I brought in to close the trade, right? So this becomes 42 cents divided by the $39 strike price that I sold. My net return on this trade, if I were to buy this back, is 1.07%. That doesn't sound like a whole lot, but again, remember, we're going to be able to do this over the course of 40 trades. So that means that on an annualized basis, there's an opportunity here to possibly get up to about 43% yield on an annualized basis. 43% just from put selling, from taking this rolling approach that the Gib loves to use, and that other people in this group scream at me on a regular basis. Why aren't you doing this? Okay, so here's what my method means. Remember, with the 12 days means I'm going to place 30 trades. I'm going to hang on to, if the option expires worthless today, that means I keep the entire 67 cents, right? So you divide that by 39, and that's almost 1.72%, a little bit under that, right? So now I'm going to multiply that by 30. Remember, I'm comparing this to 43% annualized that you'd get from rolling. In this case, it's a little bit more. More often than not, though, the rolling works out much better. And if you are going to be a roller, the truth is you're probably not going to just take the 25 cents here. You're probably going to try to wait for the market to comes to you a little bit, and maybe put in a sell to close for 15 cents or something like that. So your numbers will probably be a little bit different. Okay. So I'm going to let this hold for the time being. But here's the other reason that I wanted to emphasize this, is that one of the things to think about is not only what you get by closing the current trade out early, but what is next? What do you do with the money next? The idea here is to always try to have a plan in mind for how you're going to deploy your capital. Now, the decision may be, depending on what you feel about the market or about the stock that you're working with, the decision may be to just pull back and keep the money in cash for a little bit, and that's okay. So I'm not saying you have to be always in the market. You don't always have to have the money tied up in something. But this is a really interesting example. Look here at, get back my cursor. There we go. Again, here's the 39 that is expiring today. Here's the $39 strike. Here is the same strike price 7 days out. $1.07 on the bid. Now we're talking about something a little bit different, right? This becomes quite a bit more interesting. We could even go more conservative. 38.50 has 81 cents. I actually, out of all three of these, I kind of like the 38 at 75. I'm not giving a specific recommendation, as always. I'm gonna, keep my coward's door swinging here. But this isn't a recommendation to buy or sell. But this one is interesting. If you are a roller and the 38 is available at a bid price of 75 cents, Remember, brought in 67 over here, bring in a little bit more premium for 7 days, not 9, and get a little bit higher premium at a lower strike price by $1. That's really interesting because you're really able to. This is a really good example of not only rolling your trades but also setting up an even better potential bargain, an even potentially a bigger value proposition in the stock, assuming you ever do take an assignment here. So that's really interesting. And this is where maybe the fact that my holding on to the current contract doesn't make as much sense comes to play here, because if I'm hanging on to, let's see, it was 42 cents, and then I could turn around almost immediately and bring in 75 cents. Now I'm at $1.17. Yeah, the bid-ask spread, you're exactly right, Gib. There's a much tighter spread here. That means there's a lot more activity going on. $1.17. So there's plenty of liquidity here, is what that implies. You could get this in all likelihood immediately. $1.17. Now your cost basis goes down to 38, right? Because if you get assigned, you already cleared out the $39 strike price. So if you get assigned, you're at 38. So $1.17, sorry, divided by 38. Now you're at 3%, and you're talking about a trade that would have a 2-week roughly duration, 16 days. All right. So let's think about that. 3.077%. 365 days divided by 16 days, 16 days is almost 23 trades. We'll stick with 22. 22 times 3.07%. Now you're up there in 67.5%. Yeah, that's now you're starting to see how sometimes this ability to roll, you buy back the current one, do a buy to close, and or you're able to immediately turn around and do a sell to open on a new trade. By waiting for the current trade to expire, I'm actively giving up all of this. This is low-hanging fruit right now, and I'm saying that I'm going to pass it up. And that's the truth, because even if the stock stays above $39 today, my trade expires. The money, the $3,900 that I put in, is not going to be available until probably Tuesday. Again, that doesn't sound like a lot of time, but in market terms, there's going to be a lot of movement in the stock between now and then, and that movement may be enough. Certainly, there's going to be enough time decay here that the dynamics of all of these strike prices will be completely different. I'm not saying that the trade won't be available, but I'm saying there's going to be enough of a shift. There's going to be enough of a change that that it's not going to look the same that it does today. And it is more than likely, even if I'm getting the kind of movement from the stock that would be favorable for the position on a net basis, it's probably not going to be enough to keep the conditions the way that they look now, where these are some really interesting alternatives to think about. Does that make sense? I hope that helps. If any of you are working with, as always, if you're working with EMN, you have some comparable numbers, maybe you've done something different, feel free to drop it in the chat. Love to see it. Okay. So that's EMN, or excuse me, FCX. Sorry. We already talked about EMN. Let's go ahead and let's talk about the other put sell that is on deck is Nike. And on this one, this is the trade that I placed this week. I sold the $62 strike price on Wednesday, bringing in a little over 2% for a 3-week trade. So this doesn't expire until the first week of December. But let's go ahead and check in on it, see where we're at. Again, at 62 on the strike price. Sorry, got all my windows mixed up. So this is a stock that had been, here it was roughly, it was here on Wednesday, and we're starting to see, saw a couple of gaps up, right? Wednesday up to here, yesterday up to here, up near 66. And now it's dropping back a bit, kind of following the rest of kind of following tech stocks and a lot of the market that is selling off a bit today. Jay, yeah, coulda, shoulda, woulda, right? Now, depending on what your purchase price is, that doesn't mean that there's not a covered call to be sold today, right? But certainly not as high as up here at 66. But with the stock at 64, here is the strike price that I sold. I'm still in a pretty good overall spot. Now, there is still 21 days to expiration on this, so I've got to keep that in mind. I've got a $2 spread here between the stock's current price and the strike price that I've sold. So that does give us a little bit of room to work with, and that's nice. There's not enough here to really think about or worry too much about what kind of rolling opportunities there may be 2 days later. But let's go ahead and just check in on it. All right, here's the December week 5. Yeah. Really big spread between bid and ask at the $62 strike here right now. So I brought in $1.30. You might split the difference here and you're still looking at about $1. I'll give it another week. We'll check back in next Friday and see where things stand. For now, I'm really not worried about this. In fact, I'm not worried about it at all, just because, number one, 62 is a price I like for Nike. This downward trend has gone from a short-term to an intermediate-term downward trend, and we see the stock below the 20-day, 200-day, and 20-day moving average right now. So there's a lot of bearish conditions in place right now. That's part of what is creating the value opportunity. That's where the discount is coming from. The fundamentals are still really solid, and the last earnings report included some good information, some good numbers that have kept things looking pretty attractive. So with the stock down here in these levels, I'm not too afraid of it, even if it does drop a little bit below, even if it drops below 62. That'll just set up some additional opportunities here to work with a good stock that I already like. This kind of news. This is just one. We're talking about one set of analysts' expectations. We're looking into the future. This is their crystal ball read. I don't have a crystal ball read. What I know is that based on the most recent numbers, Nike is in a pretty solid spot right now. Stock market price notwithstanding, fundamentals are solid. The dividend is useful enough even if it's not huge. So even if I were assigned at 62, that's still okay. Still really checking all the boxes that I want. So again, as always, if you're also working with Nike, you want to throw out your numbers for comparison, love to see them. Go ahead and do that. Okay. Let's take a look here now. That's really all of the put sales that are on deck. We've talked about all of them, including EMN, which we opened up with. So let's start going through some of these covered call trades. Start with CTRA. This is a stock that I was assigned in mid-October at $24 and had an opportunity to set a covered call trade just a few days later. Now, this has been a 30-day trade, but I was assigned at 24, was able to sell the 24.50 strike price, bringing in 45 cents, a little under 2% in premium for that. And that's okay. One of the things that I'm really not trying to do when I'm setting these trades is trying to get the maximum number of dollars. My expectations are pretty conservative. In reality, what I'm trying to target on an average basis is about 1.5% over a 30-day period. Means that sometimes you're going to see some covered call trades and possibly even some put selling trades from time to time that may be a little bit below 1.5%, just because I'm trying to think about it on what I want my 30-day average to be. In this case, I'm above that, but the 1.88% may not be as attractive as some of these others, right? But still, this is a nice setup, especially for 30 days. This 4.5% I got with Skyworks, that was outsized. We'll take a look at that stock and see how that's treating me as well. But on CTRA, we're doing okay. 24.50, bringing in 45 cents. This is a nice setup. So let's see where that stock is now. Barry got called out on CTRA last week. The $50 capital gain and 2.33% yield on the premium. That's awesome. And so right away, Barry, I love it. I think that's great. I'll give you that right away. I still have to wait another week. He was already called out. So you get, in fact, I'll give you two tick marks. Not the first one is just replacing a good trade. The second one is for increasing your trading frequency. Yeah, 3-day trade. I mean, come on. Okay, fine. Three for 3 days. All right. So the stock's at 25.61. Again, it is pulling back with the market a little bit and has been dropping off of this peak near 27. But here's my purchase price all the way down at 24, and the strike price that I sold is right here at 24.50. So still got some room there for that. And with a week to expiration, this is looking pretty nice. This is looking like there's a good chance I'll get called out. It means I hang on to all of the premium, obviously. Plus, I get about a 50 cent gain in capital gains on the trade on a net basis. And again, maybe that doesn't sound like a whole lot, but again, remember we're talking about when you say low hanging fruit, you're talking about what's easy to get, and it may look so small that the rest of the market. This is why it's the low hanging fruit. Why the rest of the market isn't paying attention to it. It looks so small that it's easy to just say, "Eh." But first of all, I got brought in 45 cents. That's the 1.88% that we already talked about. If I get called out, I'll make 50 cents in capital gains on top of that. So that's 95 cents. I also have the 55-cent premium that I brought in from the original put sale. So I'm looking at $1.50 all told. That's just from premiums generated on a trade that started in mid-September. So if I get called out next week, this is a trade that will have taken a little over a month. So let's divide $1.50 by 24. There's 6.25%. Let's go ahead and call it 38 days, right? Call it 5 weeks. You can get 6.25% for. This is still not quite as nice as what Barry's able to do in terms of trading frequency, right? Your trading frequency is going to be, Barry's is going to be higher than mine, so his net numbers are going to be a little bit higher than mine here. But assuming I get called out on this, this is a really nice net overall result. 365 divided by 38. That's 9 trades. I can't round up. So 6.25%. If I can do that all year long, 9 times, 56%. This is why I say that these numbers that I'm showing you, that I'm calculating to represent annualized returns, they're simplified. They're ultimately estimates. Barry held it for a little over a month. Awesome. Okay, thank you. These are generally simplified numbers, but CTRA in this case, this is a really, really good example of what is actually what is realistic. This is why you set these up. You're not every position, not every trade is going to work out like this, but the fact is you do get you do get some like these where they do. And so you talk about the law of averages and those kinds of things over time. This is what makes the simplified numbers that I tend to generate and tend to show you for illustrative purposes kind of play out over time. Okay, then there's the flip side, and that brings us to Skyworks. Now, this isn't a bad thing. This is just one of the realities that sometimes happens when you're working with stocks the way that we do. And in the case of Skyworks, this was a stock that I was assigned beginning of October at 75, bringing in about 2.4% for a 2-week trade there. Implied volatility on the options on Skyworks was pretty elevated through most of October. And so even though I was assigned in mid-October here, that set up another opportunity to sell a really nice covered call trade at 77.50. Okay, I brought in 4.5% on this for a 30-day trade, $3.40. This is another one like EMN doesn't offer weekly options, so you had to work with monthly options or not at all. But let's take a look at this. And we see the stock here is at 67.55. Here's what that looks like on a stock chart. Gib, thank you. This is a good question. Does my summary page show your returns for the whole time frame? Yes. Now I have to update it periodically. The last update I made was what, about 10 days ago? So that's the result of all of these trades all the way up to all the way to here. So I don't have anything from FCX and above. I have to update that. That's a manual update that I have to do periodically. So I don't do it as often as I probably should, I'll be honest. Okay, but here we are at Skyworks again, and this push was what allowed me to sell. Here's 77.50 roughly. There's a 77.50 strike, and people might say, "Oh man, look at this! It got all the way up here around 86, and you didn't get called out." Well, I didn't get called out because they had a month of expiration. I was assigned, my purchase price is right here around 75, and we've watched the stock. You know, this is where volatility can sometimes, not always, but sometimes, you know, snap back on you. Saw a really hard, fast rally all the way up here to about 86, and an almost equally aggressive drop back. And now we're down here in the 67.60 range. So clearly I'm down below the price that I was assigned. Also, you know, this isn't great. I'm not going to lie. Seeing the stock down here below 68 when I bought it, when I was assigned at 75, I don't love that. Now, there is a functional reality where I can say, okay, I brought in $3.40 in premium on the covered call. I brought in $1.80 on my initial put sale. So there's $5.20 of premium that I can count against my cost basis. That means that my actual cost in the stock is about $69.80. That makes it a little bit easier to digest, but still, the stock's around $67.50. I'm still more than $2 underwater. I don't love that. And I don't have to. I don't have to love it. What I do have to do is decide if this changes my evaluation of what the stock is doing right now. It also goes ex-dividend in about 4 days. I'll qualify for this dividend here, which will be nice. That's an additional 71 cents on top of the 520. So just for literal plus 0.71, that'll bring my income to 591, which means my net cost is now closer to 69. Okay, that helps. That does make it a little bit easier to think about the overall fundamental strength in the company and whether or not I'm willing to stay in and endure this decline. I do see where the stock should have pretty strong support right here in this 67.50 range. And if this does hold, it is interesting to see these pivot lows. 1, 2, 3. I can't say that 3 is confirmed here, so I'm going to put a question mark here. But if that holds, what kind of a pattern is this starting to set up? Any of you that have been studying technical analysis might be able to give a bottom, and specifically, there's a name for it. I'm going to leave a question mark there because I don't know yet. I don't know yet if that's actually a triple bottom. In order for this to confirm, well, we would have to see the stock rally. We'd have to see it start to push above. And the thing that is interesting about triple bottoms is these become patterns these are long-term patterns, and this is why they tend to be kind of powerful when they start to manifest, is because of the time they take. Literally speaking, this thing started at in May and June, all the way until the end of the year. This is we're almost 6 months into this pattern. That's actually really normal for a triple bottom. These don't happen in a few weeks. These usually happen over the course of months. The length of time that it takes for these patterns to form is part of the reason that they're so powerful as an indication of long-term trend changes. Now, I'm not calling for a trend reversal yet. Again, I can't say this is a triple bottom because we haven't actually seen this as a pivot low yet. But if it starts to rally up, then that likelihood starts to increase. More importantly, what we'd have to start looking for next would be a push above resistance. And you can use a lot of things there for resistance. We could use the moving averages if we want. I usually prefer to pay attention to where I think the top of the range has been. So we've got here, this might be around 74. We could probably go up here. I'm going to call this 78. Now, there's a little bit of different distance between these. So again, this would take time to carry out. But if we see the stock push above these levels, 74, 78, all of a sudden, what we'll be talking about when the stock reaches these levels is a trend reversal. We're not there yet, but we're getting very close. And that also means for my trade, remember I'm in here at 75, right? So a little bit above this. Here's my purchase price at 75. Assuming we get this sustained momentum back in a positive direction, you talk about buying stocks at discounts and being kind of a contrarian, and when you can set up these entries, when you have the opportunity to set up these entries, when these kinds of patterns are starting to work themselves out, this is where contrarians end up being at the very, very beginning of sea change kinds of shifts in a stock's momentum and direction that give the contrarians the big edge when the stock starts to pick up momentum again, when the rest of the market starts to recognize how discounted they are and they start to push them even higher. So this is a really good example of how sometimes just paying attention to the patterns, to the technical indicators that are there, works out. This is also a really good example of how you can, using some of the analysis methods we use with Rebel Income to try to identify, undervalued, discounted stocks. Don't always get these kinds of long-term patterns. Sometimes these long-term trend reversals come more quickly. Sometimes they don't come. The stock could still continue to break down. We'll see. Tech stocks right now are selling off. Looks like a lot of that may just be motivated by profit taking. And a lot of the other stocks, the Nvidias and Apples and some of the others of the world that are trading at very, very much higher multiples than Skyworks is. So we'll see. I'm not calling a bottom here. I'm saying it could be. This level down here around 67.50, 67 is looking pretty solid, even though it's testing it right now. So we'll see. Okay. Barry, all the calls he's been able to write for Intel, his cost basis is now below 32. So that's outstanding. Let's go ahead and check in on Intel, because again, this is another one that's we did very much like Skyworks in terms of its overall rally. There we go. This one peaked at about 42, and it's been dropping back since. He says currently have a call for $40, so that's probably going to expire. That expires next week, but you were able to write that on Wednesday. The stock is down about here, and he brought in 67 cents expiring next week. So that's pretty awesome. So if your cost basis is around 32, 67 cents, it's 2.09% for a trade. You place it on Wednesday and it expires next week. That's for 9 days. Again, that's something to really be happy about. So there you go. There's another tag mark for you. Really good. Thank you, Barry. That's another good example of just what sometimes this allows you to do. Also means that these kinds of declines, nobody likes to see these. Nobody likes to see the stock drop from 42 to 35 in a matter of 2 weeks. But also allows you to be keep them in a little bit more objective light. Okay. Hope the downtrend is due to overall sell-off, not going back to its old ways. I think just on the basis of how broad-based the sell-off is, it's not unique to Intel, Barry. I'm going to go ahead and say it's mostly profit-taking. It's a broad-based tech sell-off that's not fundamentally driven. It's mostly coming from, I think, momentum traders. That's just my read from the cheap seats. Take that for whatever you may think of it. Okay, a couple of other covered calls. Here's one on BMY, Bristol Myers Squibb, at 47. This is a stock I was assigned at 46. There you go, Jay. People got to pay for Christmas. Don't want to put it on their credit cards. And that's okay too, right? No problem. That's fine. Brought in $1.01 on this one, a little over 2.2%. As I mentioned, I've held this one for a little while. Well, not for a ton. I was assigned in on the 10th in late September, so I've held this for a little over a month. Was assigned at 46. I have followed this for so long that I tend to think that I've held it for longer than I have. And again, this is seeing a pretty sharp sell-off today. Company and Johnson & Johnson paused a late-stage trial for a blood clot drug due to poor prospects. Okay. So that's a stock that isn't even in distribution yet. It's been in their development pipeline. That's a setback for their pipeline, but that's what's driving this right now. Again, this is about a week from expiration. So we'll see if it stabilizes or not. I may end up holding the stock a little bit longer, and that I'm okay with that. It's down here at the low end of its range right now. I don't mind holding on to this one for a little bit longer. I already brought in this premium, 62 cents, along with the premiums from the put sale and the covered call. I'm doing okay on it. All right. The other covered calls that are set for expiry on the 21st are on SLB Limited and Halliburton. So let's take a look at Halliburton really quickly. This one's at 27.44, showing some nice momentum and lift. And my covered call on this one is at 28. This is one that I've held for a little bit longer, and I've was assigned previously on this one. Got to dig back a bit at 26. So if I'm called out on this one, I've got about a $2 capital gain building on this one potentially. Right now it's below that, but we've also got a week to go. If it gets up here into the top of its range again, I'll be okay. If I end up holding it a little bit longer, that's okay too. I've been holding it. I've been taking in the dividends, which are nice, and it's been doing enough. So we'll see if that holds out or not. Here is SLB Limited, currently at 36.63. And this is one I've been able to place a lot of covered call trades on. I'm in on this one at about 35. I sold the 37 strike on this one, and it's a little bit below that again now, kind of like Halliburton. See if it picks up some momentum, but this upward surge since October has given me the opportunity to place like 3 covered call trades on the stock, which has been nice. So we'll see where all of these land. We've got some time. We are a little bit over time now, so I really appreciate everybody's participation as always. Thank you so much for being part of the Rebel Income community. Please do share this with your friends if you think that there are people you know that would benefit from the things that we talk about, maybe from trying out some of the trading methods. Please do invite them to come participate in this live stream. Have them subscribe to the Rebel Income Substack blog, and would love to see this continue to grow. Really appreciate everybody. I hope you have a wonderful weekend. Hopefully BYU gets back on track. They kind of messed up last week, but that's me. Hope everybody has a wonderful weekend. If anything comes up between now and next week, as always, please reach out. rebelincomesystem@gmail.com is my email address. You can also contact me on Substack or on Discord. Thanks again, everybody. Talk to you later.